Okay, so this is a journal entry for a standard transaction that a business might have. This business is in the business of selling water bottles. So on January 19th, the firm sold water bottles, and they sold $5,000 worth in these water bottles to one customer who pays on account. That means we don't get paid in cash. All right. Cost to you, this is so we're doing the journal entry for our own business of the bottles used up was 1,500. Used up is basically the inventory that's sold. All right. This reminds me of a story of one of my friends. He used to sell water bottles on the street of Vegas, and he used to price discriminate based on how sweaty the people looked, and would charge them different rates. This is a pretty good markup here on water bottles. All right. So we're going to have a couple transactions here. So let's start off with our debit and our credit associated with what we sold. All right. So we sold something. We're in the business of selling these water bottles, and so we're going to have some revenue or sales with here, and then we're also going to get this account receivable. All right. Well, accounts receivable is an asset. So AR is accounts receivable. Accounts receivable. All right. And the accounts receivable amount is going to be for $5,000. All right. $5,000 is what we're going to write down. And we're going to do this to make sure that we track it. So that's a $5,000 right there. All right. We're going to do this to make sure we track them and that we know that we have this resource of accounts receivable. Corresponding to that, this is a revenue. This is revenue or sales. We could call it water revenue or sales. Revenue of $5,000 is also going to be recognized. All right, so that's going to be our credit. Revenue of $5,000 will be credited. All right, next will be our debit. All right, so the debit and credit associated with the bottles used up. So we've tracked the revenue. This is the revenue portion. We've tracked what's gone on with the revenue, and you could rearrange the order on all the ones here, but we're going to do it. I'm going to bundle it together so that you can see how this works. So we have a new debit here, and so this debit is going to be related to the inventory that leaves. So what happens? We have inventory that leaves is going out of our business. Inventory is leaving in the amount of 1,500. All right, 1,500, and that's our inventory leaving. It's decreasing our assets. It's a total decrease of assets to get to this inventory level. And so this inventory is going down, and it is going to be a credit. So inventory and 1,500. So what do we call this right here? We call it cost of goods sold, COGS, cost of goods sold of $1,500. All right, you could call it inventory expense if you want, but cost of goods sold is usually what we write this as. So cost of goods sold is what our debit's going to be for $1,500. Now, some of you, again, so this is the entries related to clarifying the expense and then the revenue. And some of you might have thought, oh, out of the gate, I need to net my 5,000 by the 1,500. All right. And if you did that, you would have gotten basically 3,500 here, right? You would have gotten $3,500. But guess what? And you might have wanted to write the entry like this. You might have wanted to say, oh, we have an account receivable of 5,000. We had inventory leave so we'll have a debit here, a credit here of inventory of 1,500. And you know what? I'm going to call this next credit a gain. I'm going to call this one a gain, and I'm going to call it 3,500. And you're like, man, I've got my debits, I got my credits equaling my debit. Everything's aligned. Man, I nailed this problem, and you would have gotten 0 points. You would have gotten it all wrong. All wrong. And the reason why it's wrong is because this entry takes out all the detail with this gain. Again, remember, We want to have a financial statement and reporting that reports revenue amounts and the costs to earn those revenue amounts. And so we break it out. And so while you might have done this netting in your head, the reality is on the income statement, you're going to have revenue here and expenses here, and it's going to be detailed, not netted to this amount. You were skipping that and going straight to it. So the point of this is to not see if you can do basic, arithmetic or subtraction. It's to see if you can know how to organize things. So this is what we'll want our income statement to present. And so we need to bundle the revenue together with just revenue, expenses with just expenses to get this, which will be our net income if this was the only thing that we had on there. Again, this is not correct. This is a wrong. And if you do it that way, I'm just going to do a big circle around it. If you do it that way, you're going to get all the points off. It's going to be horrible. It's going to be really, really sad.